recording now.
All right, well, let's call this meeting to order.
Thank you.
Welcome, John, and Jim. Thanks for joining in. Aaron's on Teams as well, on vacation still. So I think we've just got this to talk about. This should be the third and final before we send this out to the entire board before we've had the last two meetings, kind of narrowed things down. And if you guys want to take the way, John, have at it.
Thank you very much. Thanks everyone for your time this morning. So this is our third meeting on this, and again, the intention here is this would be the draft. We do have a final edit based on today's discussion. If we, with respect to the mix to the U of S versus mix 2, that based on the outcome of that, we may delete some slides from the appendix, kind of simplify the message. But John Ferrone, again, is here with us. He's out of our San Francisco office. He works in the capital markets group, and then of course Jim O'Connor. We appreciate everyone's patience. This is one of the most important decisions you make as a trustee with respect to the overall allocation and the asset structure. So we're delighted to be nearing the end of the project. We think we made some great progress, and Jim O'Connor is going to help us advance the slides. Jim, if you want to touch the next slide. And see here. Okay. So again, today we're going to do the two tabs are the asset liability study, the executive summary. Again, this is the overall. Those are the takeaways, and then we have the asset allocation. And then John's going to spend a moment or two on a couple select slides from the liability portion to kind of explain that, to tie it all together. And then with respect to the international equity structure study, we do have a little bit of a discussion in terms of what the committee feels is the preferred approach. And then we'll highlight that while we make the presentation to the board. Let me open up to any questions. Again, whether you have a question now that we can get in advance, or at any point in time during the presentation, please feel free to stop us and ask your questions. So with that, any questions? Okay, John Ferrone, take it away.
Hey, thanks, John. Hey, good morning, everybody. So we'll hit the asset liability study first, and so the key findings are summarized on the page 3. Okay, so where are y'all now? Right now, y'all are actually over 70% funded. This is the end of last month. So what we did was we put in your current asset value of it's actually is at $1,015,000,000. You guys cracked that 1 billion mark. So $1,015,000,000. That's on the asset side in there. So over 70% funded right now. Just as a reminder, in terms of what your current policy, we're projecting that's going to return a little bit over 7% a year over the next 10 years. And just a reminder too, when you look at kind of the actuarial side of things in terms of what the actuary is projecting we need to get, right? They're projecting 7%. So your current expected return is north of that. If we just focused on your current policy, that remember you're about 73% funded right now. And so what we're doing when we project things is we look out over the next decade and essentially look kind of year by year and say, okay, we look up 2035, 10 years from now, what do we project the funded status is going to be? And so we project that from 73, y'all go up to about 90% with the current policy over the next 10 years. And that's really a combination of two things, right? As y'all are well aware, you guys are making material contributions to the fund, right, to make up that deficit over time. So that's obviously a key lever in terms of getting yourself to kind of 100% fully funded. And obviously the other piece of the equation is what we're focused on today in terms of the investment policy. Okay. And just high level reminder from the past two meetings that in terms of Callan's projections that we view, again, we're not looking in the review mirror, we're trying to look forward over the next decade, that Reminder that, think about fixed income expected returns that we think is much more favorable now going forward. And we talked about that at some length in the previous two meetings that, fixed income is your defense in the portfolio. That's kind of your anchor that controls the risk, or if you have a period, remember, like say in 2008, where the equity market declines materially, right? That's going to be the piece of your portfolio that's going to protect you, right? So again, we think fixed income is quite a favorable asset class right now, and as you all remember, that's reflected in kind of the recommendations in terms of, hey, maybe we take a little bit of the equity off the table and diversify by adding into fixed income. Okay, and that's the bottom of the slide there, right? That where we kind of left things off, 2 or 3 weeks ago. I think the committee was on board of kind of migrating away from the current policy and adding a bit of fixed income. And I think what we're kind of the one kind of fork in the road we want to kind of put to bed today, if you will, is how we actually want to do that. Do we want to increase the fixed income by taking it just from the international equity, which would mean the portfolio has a bit more of a tilt to U.S. equity in the portfolio, or do we want to do it in kind of a balanced fashion where we take proportion amounts from U.S. and international equity to fund the new fixed income? So that's kind of 30,000 feet. But let me pause there and see if there's any kind of initial questions before we dig in a little bit.
Anybody? There's none here.
Okay, very good. And again, we're just going to hit kind of the main slides here because I know we've hit a lot of this stuff in the past, but let's just hit 10 real fast, just as a reminder where you all are. Right. So and in the so I've updated. You see the table at the lower left. So I've updated that to reflect again your current market value as well as the actual liability as of the end of last month. So that's where that 73% funded ratio is coming from. Again, the portfolio, those blues are your equity, right? So what we're talking about here is shaving that down on the margin and adding a bit more to the core fixed income, that green, right, which is kind of the defense in the portfolio. If we go to 11 real fast. Just a reminder, if you look at the fixed income in terms of core fixed income, and again, think of that as investment grade bonds. Again, we're forecasting something pretty close to 5% over the next decade for them. And again, that's why, we think they're a relatively attractive asset class right now. And if we look at the other two main things in your portfolio, right, the two kind of flavors of equity, if you will, that's immediately above it, the rows above it, right? So we've got the U.S. equity market and then the international equity market. And you can see when you look at those expected returns, we're projecting a marginally higher expected return for international equity versus U.S. equity. I mean, it's pretty similar at the end of the day, but if you kind of lifted up the onion or whatever, lifted under the hood of the car or whatever, that it's really valuations that are driving the fact that our forecasts for international are slightly higher than the U.S. That basically we're kind of giving a haircut to our U.S. forecast given where current valuations are, right? Okay. So then the key slide is page 13. So, and so we've been looking at this one. This is kind of the third iteration of this slide. And as you all know, we've taken a long journey, right? We explored, private credit, a number of different asset classes, right? And then we ultimately settled on, hey, let's take our existing asset classes and see if there's a way we can kind of rejigger them a little bit to get a better portfolio. And that's what you see represented on the table on 13, right? So you see shaded, that's our current, and I think, kind of the crux of the discussion, I think, on the asset allocation, asset liability slide is, okay, I think we all agree we want to increase fixed income, but do we want to do it in a fashion, this kind of balanced fashion, which is mix 2, or the mix 2 US, where, and let's just focus on mix 2 US. All that's happened in mix 2 US is we're increasing fixed income, core fixed income. You see we're increasing that 4%, right? We're going from 16 right now up to 20. So we're adding 4% to fixed income. And obviously we got to take money away from something to add money to fixed income. And so in that mix 4 US, you can see that all that 4% is being taken directly from international equity. You see how it's going down, or it's going down 4% from 23 down to 19, right? And when you look at, in contrast mix 2, you can see it's kind of more balanced in terms of those things taken away. And I think, let me pass it back just in terms of, have you all given some additional thought in terms of which kind of fork in the road you guys are thinking about right now?
Yeah, we probably should have had more of a conversation on this, I guess, prior to now. But as of the last meeting, yeah, right. We, there was some mindset of trying to be a little more aggressive and not even going with the fixed income. I personally, this is Trey, by the way. I'm of the fan, if we're going to make a move at all, that it needs to be in more fixed income, be it mixed 2 in some form or fashion. I'm not opposed to the U.S. bias, but from a return sake, I think Commissioner Hensley brought up before that, our current doesn't seem to be so bad from a return perspective, and even after looking at, our liability there, in terms of volatility, I guess. Anyway. Commissioner Hensley, do you have anything to add?
Yeah, I mean, I think that was, you all are bringing back to us a couple little tweaks. The question from me is, do you think that they're necessary? I feel like we've done pretty well. I feel like we're on a good path. Are we tweaking for tweak's sake, or are you feeling like we really need to make an adjustment here? Are we seeing some headwinds that you're getting a little nervous about, that we maybe need to go a little more fixed income? Is there a concern if we stay where we are?
Yeah, so, but you're right. There's nothing broken right now. Like you said, the current policy has served you well. That I think what we're proposing is that, hey, we've had a huge run, in particular for U.S. equity over the past 15 years. And if we look at valuations, P/E ratios, or however you want to measure them, I think nobody could, the U.S. is expensive, right? And so it's, again, what's changed from when we did the state last time? Equities, in particular U.S. equities, got more expensive. And in some sense, fixed income's got a lot more cheap, right? Because you're getting a lot more yield on fixed income right now, right? So, you create a more diversified portfolio. It's hard, right? Because, I mean, to be honest, that, like you said, if the goal is, hey, how do I try to minimize my contributions over time, right? The reality is, at least on average, the answer is, hey, be as aggressive as you can be, right? Because on average, you're going to make the most money by being very aggressive, right? So the hard part is, okay, we know what's going to happen on average, but then when we get to a downside, right, we know that downside is going to be much worse if we have a portfolio that's got far more equity than fixed income. I mean, I go back, I think I mentioned earlier, like you think about 2008, you had the S&P 500, it went down 37% in 1 year, right? And so imagine what kind of hit on your funded ratio if you get something like a 2008. And I'm not saying we're going to, but certainly equity valuations are pretty elevated now, like they were back then, So I guess what we're saying is, hey, here's an opportunity to maybe take our foot off the gas a little bit in terms of what the portfolio's expected return is going to be. You see it's only going down like 0.1% in terms of that expectation, right? So in our mind, and again, we can't decide for you, but in our mind, that seems like a favorable trade-off, to, hey, let's let some air out of the tire, but then if things go south, we're protected. But we can't tell you what the right answer is, because I'm told candor, there is no right answer. It depends on what your risk tolerance is.
Hey, John, I got a question.
Yes, sir.
With the market that's booming right now, and it looks like the foot's on the gas right now, and it's going to be robust for a little while, or quite a while. But I just, how long do you think this is going to go?
Tommy, I don't know. Yeah, just, flick to page 33 real fast. Yeah, we're looking at the valuations over time here, right? And we're kind of back to where we were, before we had that big correction in 2022, right? You got a variety of metrics on this page. I don't know. I guess, we're not in the game we're trying to create kind of a robust asset allocation that's going to last over time, right? We're not in the game of like trying to time stuff. What we're doing is we're looking at the situation and trying to make an informed bet based off kind of the odds of how we assess each thing happen. I don't know if you want to jump in, Jackson, but
Yeah, I guess I would just say at the end of the day, the assumed rate of return for the fund is 7%, and we're looking at that going, okay. So to accomplish that in the most efficient way possible, how do we arrive at that? Now, the reality is looking at a 7.12% projected return versus a 7% or a 7.01% return are materially, so significantly different that we would say, hey, something has to be done, you're taking way too much risk, right? And so the idea here is how do you arrive, the math is arriving at that 7% assumption in the most efficient way possible. And the result is that you can get there by taking a little less risk. So going from 63% public equity down to 59 to 58. So that's kind of how we arrive at it. And that is, our thoughts in terms of, okay, do you want to bite off a little bit more risk and know longer term that may reduce your contributions somewhat, but in the interim, you think that I guess if we look at the last 5 years, the S&P 500 has generated a 16.5% annualized return. Well, if you go back to 1926, it's more like 10.5%. So what we've experienced is a run up in the equity markets, and the question is, the rationale for taking on a little more risk than you could if you just wanted to meet your actuarial assumption. That's how we arrived at the optimized portfolio or the alternative. And again, it's all about trade-offs, right? So you take out a little bit more risk in the longer term, then your contribution might be materially less, maybe less, but I'm not sure how much less that would be if you have a downturn in the market.
So I've been pretty vocal about this through the last couple meetings, but I'm obviously, this is Trey, by the way, I'm in favor of taking a more fixed income approach. And again, I'm going to echo both Johns in that it's institutional investing. It's not that I'm 30 years old and I want to be able to retire at 65. So I'm going to have to be inherent to a little bit more risk early on to meet that demand. I just need this thing to survive and be solvent 125 years from now. And again, if we project a 7% return and that's our assumption, then it makes sense as long as we're diligently making that or trying to make that in the safest way possible. That's what makes sense to me. And safe and my name generally don't go hand in hand. So I'm thinking that, just personally, I'm a mixed two person, one or the other. I think there could be case made for both, possibly a slighter upside to the U.S. bias, I guess, in terms of return. But, I don't know. I'm firmly in that we need to, if we're making a change, that it needs to be in the fixed income arena. I'm also not opposed to stay where we are. So that's the whole deal. Anyway, that's Trey's take on it. And yeah. Anybody? Tommy?
You know, I've always been one that, you know, I want to be safe and I want to make sure that my great-great-grandkids, which I'm never going to have, but are taken care of, you know. I think I like if we're going to do the change, I'm like Trey. I think I like the mix two, but the U.S. equities, you know, keep it there because it's, you know, it's done us a lot of good over the years.
What are we actually deciding today? Which one of these mixes to present? We're presenting three? Or what are we actually deciding?
That's a good question. Are we really just trying to narrow this down to a single pick today, or are we, you know, we're just trying to make this draft where we take it back to the entire board, is that correct?
Yeah.
Do you want to narrow it down to?
I'd like to narrow it down today, personally.
Yeah, I guess our take was, you know, the committee, in terms of how you want to present it to the board, do you want to present a solution, say, hey, we've gone through these mixes, we've had extended discussions, we think in our minds, this would be the recommendation to the recommended. Or I've had a lot of occasions where the committee comes back and says, okay, we have it down to two, and this is the pros and cons of each, and let the board decide. So this is really where, you know, you all have the opportunity to kind of fashion the argument to your, or the recommendation to your board, whether it's a single alternative or one of two.
So are we presenting our current and then an option to change, if that's what we want to do?
I need you for just 2 seconds.
Yeah. Okay.
Excuse us, Ethan has to step out for just a moment.
Yeah, I guess we see the current as an option, right? We don't see it as a something must change, but we're looking at this saying, okay, let's look at it through the lens of a more attractive fixed income environment than we had 5 years ago, and whether or not, you know, current is listed there as an alternative because staying with the current is a selection, right?
Our expected rate of return 5 years ago when we did this, John, was it at 7 or was it at 7.5? Do you know? Were we trying to hit, had we dropped it then? Do you know?
I apologize, I can't remember.
It was, Ms. Hensley, we dropped it, our last experience study, we dropped it. Was it 7? It was either 7.5 or 7.25, and we took it to 7.
We went from 7.5 to 7.25 to 7.
Yes, so I've been here 8 years and I've seen it move now twice. So yeah, down both times, unfortunately for you. But
Well, I just can't remember if when we set these current, we were trying to hit 7.25 or 7.5 versus 7. I mean, we're just moving, which again, I'm just making the statement. I'm not advocating that we don't move more fixed income. I'm not opposed to moving more fixed income. These are incremental adjustments that I don't think are gonna topple the boat by any means. We have a giant fund, and these are little tiny tweaks. So, you know, don't hear what I'm not saying. I'm not opposed to just moving slightly a little more conservative, because usually I am conservative. That is synonymous with my name. So, you know, normally that is not an argument that I'm against. But I do want to make sure that when we're looking at the current allocation, that we understand that when we set that up, we were aiming for, if we were aiming for 7 or 7.25 or even 7.5, like where we were shooting for. Because I do think it's important to know, you know, we set that bogey, you know, we set that expected rate of return based on our actuarial assumptions. You know, we've moved that a couple of times based on the market returns and where we thought we could be and trying to be a little more conservative in that, thinking, you know, we just can't go up forever, which I think is realistic. So, you know, again,
If my memory serves me correctly, 5 years ago is when we dropped it, and we did it, you know, it was 7.5, and then a couple of years later, we did it to 7.2, and then we came back down to the 7. I think it was just kind of a stair step down, if I remember correctly.
I have a note from December 22.
Yeah.
About 7.
Yeah.
So.
yeah, I was gonna say I could go back and look at my notes when I'm in the office, but I don't have it with me today.
And I'm not here to push this off on somebody else's subcommittee or the board or whatever. I think there, as well as you know, Commissioner, there's opportunity for us to lighten that burden should we not meet it. I think for me personally is right now we're looking at this and it's more of a safe play over a longer period of time. And I know that doesn't, you know, maybe I don't want to say settles well with you, but like you said, you know, I mean, there's inherent, we're not meeting, if we don't meet the mark, it puts more liability on the city, on your all's end to make the contribution. But I also don't want to think that we're in a situation where we can't make that, and also that our rate of return didn't do as well because we inherently took more risk at a time when we didn't necessarily have to, if that makes sense.
Well, I think that there's benefit in insulating the fund from some of that risk that we know exists in the equity markets that we kind of see coming, in much the same way that we said we can't keep going up forever. We don't think that we can sustain 7.5% in perpetuity. You know, if we're seeing that the equity markets are a little overinflated and we're going to need to make some adjustments and insulate against that a little bit. You know, not we, but, you know, our experts that we hire to tell us these things are seeing that and telling us we need to pay attention to that and just take a little bit more precaution than we, you know, are currently, and, you know, still have expected rate of return. I'm not opposed to moving that direction.
Yeah,
Yeah, to answer your question, Aaron, you asked, you know, what was the assumed rate of return at the last time that we had conducted the study in 2021? It was 7.5%, and you know, at that point in time, we wouldn't have been saying, okay, what do we need to get 7.5%? Because that would have been back up the truck and load up on the equities and take a materially risky posture to that, right? So the expected return, I think, with respect to the risk that we had, was in the area of like 5.96%. So it was short of your assumed rate of return to get there. Now, the horizon for the 7.5 was about 30 years, right? We're looking at a 10-year forecast saying, okay, we're trying to be, first off, conservative in our approach, but a different time horizon coming into play here, where we thought that over 30 years, you know, 7.5% is a reach. We're looking at the last 10 years in terms of functionally, how can we structure portfolios that within our career path the next 10 years we might expect to see what the markets are going to give you. So while it's, you know, not necessarily tied to the assumed rate of return, it's more along the lines of, okay, now you're in an environment where fixed income is more attractive than it was back then. Do we have the luxury of being with an expected return that coincides with that actuarial return and lighten up on the equity risk?
Got it. Okay.
Yeah.
Well, Tommy, go ahead. If you, yeah.
Well, we were, you know, in the background here, we were discussing, obviously, I think so far, at least me and Trey are, either mix two US, or stay the current. And my feelings are, I would like to go with the mix two US, but I don't know what the rest of the board's gonna think about doing.
And essentially, that's what we're looking for now. We just narrowing it down. And so I think what Tommy's trying not to say is that if we could just carry over, we could whip a vote here for both the mixed twos and the current to take back to the board. I'm open to that and open to hearing that. And I'm looking at Ethan now. He was a proponent of mixed three before, but especially whenever I look back again and I look back on page 3, and the bottom bullet of page 3 is essentially increased fixed income exposure, right, by adopting one of the mixed twos. I mean, this is coming on some advice. I think it falls within our purview. We're not undershooting our 7%, so I feel like we're holding a fiduciary there. And I don't think we're exposing ourselves too far by using mixed three. So if we're going to narrow it down and take this back to the full board, and we can have a conversation to lobby, so to speak, and get everybody's opinion, I think we take both the mixed twos and the current, put those in front of the board, and make a decision then. Does that sound okay to everybody? Aaron? Great. She gave a thumbs up. There we go.
I'm okay with that.
Back to COVID, we're giving the thumbs up again. Yeah.
Here, let me,
From a mute button.
Yeah.
there's one kind of key slide I want y'all to hit that might help a little bit, is page 25. So, and this is actually linked to Aaron's point, right? We got a super tanker and we're talking about we're making pretty incremental tweaks here if we're talking about moving stuff up and down, 4 or 5%. But what you see here, and this is kind of, you do all the meat grinder, the AL study, and this is kind of like, this is kind of a key slide at the end of the day. And so what this is saying is, okay, remember right now, you all are 73% funded. And so based off these different asset allocations, what do we project 1 decade from today the plan's funded ratio is going to be? Okay, and so what's good about this is it's incorporating both what you expect, but again, under the hood here, we're running both good and bad market scenarios. There's 2,000 scenarios kind of under the hood, and so you can see on average, and that's what that blue line is. Okay, that the blue line is saying on average, we project that if you stay where you are, we expect you to be 90% funded 10 years from now, right? So again, kind of steady progress toward full funding. And then you can see the different mixes we've been looking at. Remember, mix 1, very, a conservative mix, so that you expect the assets won't grow as fast with a more conservative mix. You see the funded ratio is a little bit less on average there. And you can see the same for, it's almost like you'd have to add another decimal point. But the point is, you can see mix 3 on average has a higher funded ratio. Why? Because you're investing more aggressively. But kind of the rub is, hey, if you're investing more aggressively, there's going to be a bigger downside too. And so that you see where I highlighted in red that kind of downside scenario. So it's kind of like in your head, you got to keep, well, I'm going to get on average, and then what might happen if things go south. Right? And again, these aren't huge changes here, right? So you can see mix 3, just to orient you, right? We're saying the downside fund ratio could be 50% for the target mix. Again, this is like pretty precipitous downward decline in equities investing. We don't expect this bad scenario, but we need to be aware of it, right? So, and then you can see mix 1, right, is the most conservative, so it has the lowest downside, right? That downside projection is 53%, but then you're taking a hit on your kind of expectation, right, in the blue, right? So you can kind of see those trade-offs there. And you can see, we compare target to mix 2 US, mix 2. You can see that the downside is better, right, for mix 2, which is kind of common sense because then it's got more fixed income, it's more conservative. But, on the margin, right, that the funded ratio, is expected to go down a little bit, right, or not go up as quickly as the target, right? So you see mix 2's 89% for the blue, and the mix 2 US is 90, and in practice, it's probably like one's like 89.4, one's 89 point, but again, it just kind of gave me a flavor for those different trade-offs, right? And I guess, you know, I mean, let me pause there and see if there's any reaction to that, or what y'all think.
Nothing.
And I guess to pretend I'm Tommy here, right, and say, well, okay, I'm looking at this slide, and John, you're telling me that, okay, the expectation is, you know, within rounding, I'm gonna get the same funding ratio in 10 years for the mixed 2 US,
Right.
but my downside's a little bit better. It's like, well, you know, I kinda like that, you know, I'm still making steady progress toward the goal, but, you know, I've let a little bit of that area tire. So it's throwing a trial balloon at you guys, see?
Sorry, we're still flipping pages here too, so.
Oh, okay, yeah, I mean, there's a lot of stuff here. I was trying to hit that. We can go through whatever y'all want, so I don't want to cut anything short. And actually, because everyone's talking about contributions, right? So let's go to 27 real fast. And so here you see the projection in terms of, and so this is like aggregating up the projected contributions over the next decade for the different mixes. And again, intuitively, right, if I have a more aggressive mix targeting a higher expected return, I would expect the contributions for that blue line to be a little bit less, right? So just to orient you guys, so we got the target. You see how it's, what, 489 million is kind of the expectation. And then as you get more conservative, those expected contributions tick up a little bit. But then in terms of that downside, when the market goes south, right, the contributions increase, right? See how the target, for example, 822 versus, let's say mix 2, either US or the kind of the regular, you can see how those contributions are like, you know, 10, $15 million less in that downside scenario.
I think what I find interesting there, and maybe I'm new to this, but it's when comparing the Mix 2 and Mix 2 US, is that in the 50th and the 75th percentile is actually outruns the US, you know, which seems counterintuitive, but
well, what's kind of under the hood there is that, remember that that US mix, because it's a little bit less diversified, it actually has a little bit more risk at the portfolio level. So what you'll see is, in kind of extreme good and bad cases, that mixed 2 US should do better. That's exactly what you're pointing out.
Yeah.
You know, that's just what risk means, basically. Yeah.
you got to win big to win big, right?
But again, you're already, if you will, taking some of your chips off the table if you're going to move into fixed income more, right? So that, in my mind, that's kind of the bigger bet, if you will, like the choice between mix 3 and mix 2, and then it's kind of, you know, it's a second order impact as you're observing, right, between mix 2 and mix 2 US.
And just looking at on the next page, 28, under net cost, that's where I was prior to that.
Yeah, so what that's doing is combining, like I showed you, the expected contributions, right? But ultimate net cost is also adding in, okay, well, we also want to think about, well, how much more we got to pay in the future to get ourselves to full funded. So it's kind of a combination of contributions, and then what's that unfunded liability 10 years from now, right? And so when you look at that, you can see, kind of the same trade-off, if you will, right? You know,
Yes.
but yeah.
All right.
And again, these are all 10-year projections, right? So this is kind of like a Rip Van Winkle projection, right? And I just want to remind everybody, it's like, okay, we're projection stuff 10 years out, but we got to live through the next several years, right? And if we get a 2008 or something like that, you know, that you can see the valuations were record highs, and we had a chance to take some money off. I mean, you know, it's easy to be money market quarterback, but again, we're just trying to play the odds, and based off our observations, I guess I would say migrating into the mixed two family, whichever one is what we'd recommend, just in full candor.
Well, if my memory serves me correct, I mean, we'll be doing another experience study within the next year or two, and that'll give us a better outlook, post-COVID of what things look like and what people have seen, and get some recommendations there in terms of what we should expect our return to be. Hopefully we're not dropping again, but, and we can stay on track here. That'd be ideal. I don't have anything else unless there's something else that one of you fine gentlemen, John, or Jim, want to add. Jim, you've been awful quiet.
Yeah, I guess my thoughts are that if you are going to bring the current and the two mixed twos as alternatives to the board, do you want us to soften our recommendation and give you some leeway with respect to retaining the current? Because, our recommendation is that, mixed two or two US, but we certainly don't feel like the current allocation doesn't have merit and requires a change. So we can soften language that if if the committee is considering to make a change, mixed two and mixed two US would be the alternative that we would propose. Something to that effect, so that you have sufficient position to show that maintaining the current is still fiduciarily responsible, right?
Yeah.
We don't mean to suggest that the current allocation requires a change.
That might be.
Yeah, I think that's accurate. Yeah, I don't take it personally. I don't take it that way that, hey, we have to make a move, first of all.
Right.
But you're right. There could be a circumstance that, very much as I alluded to on page 3, that somebody's like, well, it says right here in bold print, recommendation, these guys from all over the world say that we need to do this. So that being said, yeah, I mean, I don't know that it has to be like that, but if we choose to do something and we want to take a more conservative approach, and I think that's how I'm going to portray it to the folks that I'm going to talk to about this in the meantime. So,
Trey, and this is Jim, by the way, I have been quiet. Would it make sense then, to your point, do we just remove the recommendation altogether?
yeah, I mean, maybe if it's just structured in a way that says, should you want to, but then again, that almost leans to, keeping it the way it is, So, yeah, I mean, perhaps, I don't know. I think this subcommittee's got enough people, and we've got every stakeholder group, in here. I think we're going to talk to our counterparts and, across the board too. I don't know that it's going to matter a lot, however you have it worded there. Is there anything else anybody needs, or are we about to be on a record pace to get done here? Tommy, you good?
I think the second portion we just wanted to get closure on was the international structure, and that should be a fairly short conversation as we looked at the two options that were the outcome of earlier discussions. And, when we look at the two alternatives, I guess our preference would be to move to alternative 2, which would be to have 3 portfolios that represent the all country world ex-US flavors, both a core, a value, a growth, and that those managers would have the discretion to invest in emerging markets to the degree that they saw fit or attractive from a valuation standpoint, as opposed to just replacing Bailey and Cap Guardian. With Cap Guardian would be introducing another emerging manager, markets manager, which is locking you in terms of an allocation to that particular sector. And I don't know if you want to pull up, Jen, the slide that kind of shows the two alternatives side by side.
Yeah, it's got 45.
Is that, reference that, is that 45 we said?
Yeah.
Yes, thank you. I was looking for it there. Yeah, give us a second here if you would. What are your thoughts there?
So as you can see here, the current showing Acadian at 49%. In either alternative, we're paring them back a little bit, but under mix two, that they would be retained at 45%. So a more modest cutting back on those folks. And then with respect to instead of having a new EFA or a developed all-cap manager and a new emerging all-cap manager, we would have kind of satellites, if you will, to Acadian at both a value and a growth component. And then these managers, these mandates, they would make the determination of how much should go into emerging markets as opposed to mix one where at a strategic level, you're saying, okay, we're going to have a 30% allocation to emerging markets. So you're making that decision. Whereas under mix two, you're kind of allocating that decision to the managers to make that weighting in their portfolios.
Yeah. I feel certain that I'm almost in favor of mix two. I mean, it goes without saying, but I mean, their eyes are going to be a lot better at this than mine. Also the numbers at the bottom let me believe that it's probably a better option too. Would we take both of these back to the full board and then just explain those out there too? I mean, I think I'm following a little bit of what you're saying, but should we just go ahead and make that decision here and try to narrow it down to a single two options maybe? Tommy, Aaron, Ethan.
You're saying to show the broad border mix two, since we're on board, rather than kind of open a can of worms about having to explain mix one, or just to make sure I'm on the same page?
Yeah, I think that's kind of what I'm saying, but yeah.
Yeah, or if we say either mix one or mix two is a change from the current structure, and I guess there's, I would assume there's a fair deal of support for replacing David Gifford, which really,
Yeah.
you're moving from a current in any case. So it's a mix one or mix two move, and we could kind of explain those two alternatives if that's the wish of the committee, and just say, if you decide to replace Bailey, then we would suggest that F Guardian would also be replaced for mix one and mix two, and then talk about the merits of each.
Yeah, I think that's probably good, right? The transparency of having both. I mean, besides us pigeonholing ourselves in there, it's not like we're trying to weigh out 5 options. I do believe you're right. I've definitely heard something about making a change here, more than once. And I feel like it'll be the board's opinion, probably just their flavor to go with mix two, but maybe it's best if we do explain that. So if you don't mind, John, that'd be great.
Okay, very good.
All right. We're getting somewhere.
Well, that covers the material that we prepared for this morning. So if there's any additional questions that you'd like us to be in a position to respond to or present to the board, happy to hear.
Okay. I don't think we have anything here. Ms. Hensley, do you have anything?
Yeah.
Terrific. Well, guys, thanks as always. We look forward to seeing you. It's going to be in the, is that the September meeting that you guys are coming, or when is that? It's August meeting? Holy cow. That's like,
Couple
soon.
weeks away.
Yeah. Great. All right. Well, we look forward to seeing you then, and I think we'll be ready.
Thank you so much, everyone, for your time this morning.
All right. Thank you.
See you in a couple weeks.
All right. Thank you.
Thanks, everyone. Have a good rest of your week. Take care.
Okay. Anything else you guys have for the good of the whole here?
No, the only question I have, we're gonna hire some new manager.
let
My
them
big
manage
thing's
it.
always fees, you know.
Yeah, well, that's true, fees, but let them manage it too, you know. I mean,
Right,
there's a
right. You know.
great difference in those two,
Yeah.
portfolio return numbers, you know?
Yeah.
And one of those involves us having to do this more often, and I don't think we wanna be there,
I don't
so.
think we wanna do that either.
Yeah, slightly more fees.
Well, I mean, you know, we do it every 5 years. You know.
Well, but even if we have to be making decisions of where we're parking
Yeah,
this, I
yeah.
feel like that's gonna almost be an annual thing at that point.
Oh, yeah.
I don't think it's our responsibility to do that, you know? I think if we can trust who the manager that we're gonna put it with, I think we're okay from that perspective.
Well, I mean, you know, we're gonna be monitoring them, so I mean, if they're not,
If they're not
Yeah,
performing, that's
okay,
right,
you
yes,
know.
that's exactly right, you know?
Just
I-
like
you know.
Bailey, in 10 years, we tell them where to go.
Yeah, we're gonna
Yeah.
fire them, yeah, that's
But,
right.
yeah, the biggest question I have is, I would have gotten rid of some of these a lot earlier than we did, but, you
Yeah,
know. but
absolutely.
Still, you know.
Okay. All right, well, if that's all we have, then we'll go ahead and, end our meeting here then.
Okay.
All right.